Hey everyone, welcome back. Nobody wants to get audited. Your clients don't, and you definitely don't want to be the preparer whose returns keep getting flagged. So let's talk about what triggers an audit so you can prepare returns that are accurate and defensible. First, you need to know about the DIF score. Every return is run through the IRS discriminant information function, which assigns a score based on how the return compares to statistical norms for similar taxpayers. If a return deviates significantly from what the IRS expects for a given income level and filing type, the DIF score goes up, and the return is more likely to be selected for examination. You can't see the DIF score, but you can use common sense. If a taxpayer earning $60,000 claims $40,000 in Schedule C deductions, that's definitely going to stand out. Second is underreported income. The IRS matches every W-2 and 1099 filed by employers and payers against the income reported on your client's return. If there's a mismatch, the IRS sends something called a CP2000 notice. This isn't technically an audit, but it's a flag that can lead to one. Always pull wage and income transcripts and verify that all reported income is on the return. Third is high deductions relative to income. Large charitable contributions, excessive business expenses, and outsized home office deductions all attract attention when they're disproportionate to the client's income. Now that doesn't mean you shouldn't claim them, but they need to be real, documented, and defensible. Fourth is round numbers. If every deduction on the return ends in a zero, it looks like the numbers were estimated, not tracked. $5,000 for supplies, $3,000 for travel, $2,000 for meals. That pattern signals to the IRS that the taxpayer didn't keep records and guessed. Use actual amounts. Fifth is cash-heavy businesses. If your client runs a business that deals primarily in cash, like a restaurant, salon, or vending machine operation, the IRS pays extra attention. The reason is obvious. Cash income is easier to underreport. Make sure your client is reporting all of it and has documentation to back it up. Sixth is the Earned Income Tax Credit. Returns claiming the EITC are audited at higher rates than average. The IRS has specific compliance initiatives around this credit. As a preparer, your due diligence under Section 6695G is your first line of defense. Seventh is hobby losses. If a client has a side business that shows a loss year after year, the IRS may reclassify it as a hobby and disallow the losses. If the activity doesn't show a profit in at least 3 of the last 5 years, it raises a hobby loss presumption. The takeaway: prepare accurate, well-documented returns and realistic numbers. Don't inflate deductions, don't omit income. And document your work so that a return is ever questioned. You can show exactly why every number is there. For training that teaches you to prepare audit-resistant returns, check out MuseSpring.com. And as a quick reminder, everything on this channel is educational and provided through MuseSpring for informational purposes only. Thanks for watching, everyone. I'll see you in the next one.